Welcome to this explainer. Today, we're diving into a genuinely wild, highly speculative macroeconomic model. It's a completely closed-loop blueprint trying to do something that sounds almost impossible, mathematically linking a single act of early childhood kindness all the way up to eliminating the United States national debt. It fundamentally flips the script on what we actually consider to be human capital.
So here is the core provocative premise of the USA Values and FedNext proposal we're breaking down today. Could a $36,000 gift targeted right at early childhood development literally pay down the U.S. national debt? You can think of it as a giant economic butterfly effect, where a completely localized private sector investment in a 6-year-old's brain development ultimately cascades upward to transform the Federal Reserve's entire balance sheet.
Here's exactly how we're going to break this down. 1. Kindness as economic capital. 2. Valuing a child's potential. 3. The private sector engine. 4. Paying down national debt. And finally, 5. Testing the economic math.
All right, let's jump straight into Section 1. Kindness as economic capital. The philosophy.
It basically works like this. The whole model takes a massive macroeconomic theory and roots it in, basic human psychology. Pulling from behavioral science and the theory of constraints, the idea is that targeted kindness, specifically a $36,000 gift given before a kid turns 7, actually removes early developmental roadblocks. It builds a foundational readiness that acts as the ultimate seed for human capital, and by extension, future economic growth.
Moving right along to Section 2, Valuing a Child's Potential, the napkin math.
Okay, bear with me here, because the crucial mechanism for all of this is something called the PVOFPE pre-K. That stands for the present value of positive expectation from pre-K. Yes, it's super dense jargon, but it's absolutely vital. What it means is that we're treating early brain development as a highly quantifiable market-based asset. We aren't just talking about warm, fuzzy feelings anymore. We're literally talking about creating a bankable financial asset based entirely on a child's future productivity.
And the proposal uses a very specific formula to calculate this objectively. Step 1, project a worker's earnings all the way out to age 70, but explicitly cap wage increases after 30 years to keep the math conservative. Step 2, discount that future earnings stream back to the present day using a risk rate somewhere between 2% and 15%. And step 3, which is kind of the most fascinating part, is attributing exactly 50% of that present value directly to the foundational readiness they achieve by age 7.
Naturally, this math results in distinct valuation tiers. A child on the best trajectory gets valued at $750,000 right at age 6, and that scales all the way down to 0 for the worst trajectory. Now, the model explicitly assumes not every single child is going to hit the maximum right out of the gate, but driven by continuous improvement in the private sector, the ultimate theoretical goal here is to push those outcomes to a massive $1 million asset value per child.
Just pause and think about that return on investment for a second. We're talking about a localized $36,000 upfront cost translating into a potential $1 million lifetime asset. The sheer, incredible leverage of that human capital is exactly what powers the rest of this entire macroeconomic engine.
Which brings us to Section 3, the private sector engine, funding the base.
Notice that the systemic capital flow does not actually start with the government. In year 1, private high-net-worth investors fund localized regional reconstruction finance corps, or RRFCs. Year 2 is all about the actual on-the-ground delivery of education to the kids. By year 3, we hit the FedNext phase, which is where this human capital gets monetized. And finally, in year 4, the U.S. Treasury uses this newly recognized value to reduce the national debt.
To really wrap your head around the scale here, the model completely relies on roughly 10,000 high-net-worth individuals to voluntarily capitalize these local RFNCs. That is funding 4.5 million children every single year. We are talking about a localized private capital injection of over $162 billion annually, all driven by this highly unusual mix of financial speculation, social impact, and, basic kindness.
Now for the really wild part. Section 4, Paying Down National Debt, the macro payoff. So how on earth does local childhood development actually affect the national debt? Well, the model proposes that the Federal Reserve would step in and buy the human capital debit bonds generated by those local RRFCs at a staggering 50% markup. Theoretically, this action creates a massive $324 billion annual asset sitting right there on the Federal Reserve's books.
And here is the massive final leap. The Federal Reserve basically gifts this $324 billion asset straight to the U.S. Treasury. The Treasury then applies market value adjustments, recognizing that potential $1 million per child lifetime value we talked about earlier to scale this whole thing up. They then use this newly recognized human capital asset to retire an unbelievable $2.5 to $4.5 trillion in national debt every year.
Now, I know exactly what you're probably thinking right now. Wait, wouldn't injecting trillions of dollars cause massive hyperinflation and totally ruin the cost of living? Well, the model actually has a mechanical guardrail built in for that. This human capital valuation acts purely as created receipts money. It's strictly used to offset existing federal debt on a balance sheet. It is fully sterilized, meaning it literally never enters into general economic circulation.
Okay, let's bring this back down to earth a bit with Section 5, testing the economic math, reality checks. So while this is an elegantly closed-loop system, we have to acknowledge that it relies on some incredibly strict assumptions. On the conservative side, forcing a cap on wage increases and baking in a flat 2.5% inflation rate keeps valuations from running away. But institutionally, the legal authority of the Federal Reserve to stretch its mandate just to buy human capital bonds is highly debatable. Plus, the entire system rests on reliably and independently auditing the developmental outcomes of 4.5 million children every single year.
And to maintain any real confidence in a system like this, you can't just use a national average. Every single Federal Reserve district would have to use hyper-localized data. I mean, the cost of delivering early education and those projected future earnings are vastly different in Mankato, Minnesota compared to New York City, right? For this asset to be considered true value, it demands incredibly accurate, region-specific economic modeling.
So we've tracked a wildly ambitious model today. We went from the psychology of a single act of early childhood kindness all the way to a multi-trillion-dollar balance sheet adjustment at the U.S. Treasury. It really asks us to look at early childhood development not as a sunk charity cost, but as literally the most highly leveraged capital asset a nation possesses. Whether the institutional mechanics of this specific proposal could ever actually be realized in the real world remains a huge open debate. But it leaves us with such a fascinating, provocative question. If human potential truly is our greatest economic asset, could finding a way to systemically monetize it rewrite the future of our economy? Thank you so much for joining me for this explainer, and always keep questioning the limits of what's possible.